All right, let's get right into it. There is a huge mystery playing out right now at the very center of the AI revolution. And while everyone is talking about the boom, there's a completely different and, frankly, more unsettling story being told just beneath the surface.
See, on one side, you have the stock market, and it's just euphoric. It's betting that AI is going to generate trillions in future profits. But then you've got the bond market, the people who are actually lending these companies money, and they're starting to get really nervous about the colossal debt being racked up to pay for it all. It's truly a tale of two markets. One is selling the dream, and the other is pricing the fear. So that brings us to the big question we're tackling today. How can the smartest investors on the planet look at the exact same companies, the same AI strategy, and come to two wildly different conclusions? Let's dig in and figure this out. Okay, before we can really crack this mystery, we need to understand the key clue the bond market is flashing at us. It's a thing called a credit spread, but honestly, I think a better way to think about it is the danger premium. A credit spread is really just the extra slice of interest you, as an investor, would demand to lend your cash to a company instead of to someone rock solid, like the US government. It's a direct measurement of risk. The riskier it feels, the bigger the premium you're going to ask for. Makes sense, right? Let's just walk through a quick example. So let's say the US government borrows money at 4%. That's our baseline, our safe bet. Now, a corporation, which is obviously a bit riskier, needs to borrow money. To get you to lend to them instead, they offer 6%. That 2% difference, that is the spread. That's your danger premium for taking on that extra bit of risk. And this quote it nails the most important point. When you see a credit spread chart going up, it is not like a stock chart where up is good. No. It's a chart of pure anxiety. A spiking spread is a warning flare. The number's rising, yeah, but it means the financial health of that company is actually getting worse. Okay, so now that we get it, that a widening spread means rising fear, let's get back to our AI mystery. Because the bond market is now sorting big tech into two very, very different camps, all based on how they're handling their AI debt. So let's dive into the first camp, which we'll call the indigestion camp. This story isn't about the fear of a company going under. It's more a story about companies that are just trying to swallow way too much, way too fast. We're talking about giants like Meta and Alphabet here. These companies have balance sheets like Fort Knox. The problem isn't that investors think they'll go bankrupt. The problem is they are flooding the market with tens of billions of dollars in new bonds to pay for all those fancy AI chips. Investors are basically just taking a step back and saying, whoa, that is a lot of debt for us to absorb. We'll buy it, but you're going to have to give us a bit of a discount. And you can see that discount plain as day in the numbers. For Meta, their danger premium has widened by about 15 basis points. Look, it's noticeable, for sure, but it is not a 5-alarm fire. And for Alphabet, it's even smaller, just a 10 basis point widening. This basically shows the market has some mild heartburn from the sheer volume of bonds hitting the street, but it's not genuinely worried about the company's long-term health. Amazon is kind of a fun one here, sitting in the middle. I mean, it's always been a massive spender, but its new AI ambitions, which are topping $75 billion a year, are starting to give bond investors that exact same feeling of indigestion. Now, let's look at the other side of this. This is where the story shifts from just simple indigestion to something a whole lot more serious: genuine credit deterioration. And the poster child for this camp is Oracle. Here, the market isn't just asking for a small discount because there's a lot of supply. No, investors are looking at Oracle's massive spending plans, and they're becoming genuinely worried about whether its corporate credit card is about to get maxed out. And just look at the size of this number. Oracle's spreads have blown out by 48 basis points. That is 3 to 5 times more than Meta or Alphabet. This is the bond market's fever spiking. For real. And if you want another sign of fear, check this out. The cost to insure Oracle's debt against default has jumped to around 80 basis points, which is a 2-year high. That signals some serious market stress. So what's got everyone so spooked? Well, here it is. To fund its AI dreams and build out all these data centers, Oracle's net debt is projected to balloon to a staggering $290 billion by 2028. The market is seriously questioning if the company can really handle a debt load that enormous.
So, this really clear split, right, between the indigestion camp and the deterioration camp has created this really clever strategy that the pros are now using to trade this whole AI boom.
They're calling it the AI basis trade. On one side, they buy the company's stock, betting that the whole AI dream comes true and profits just explode. But at the exact same time, they're shorting the company's bonds, which is a bet that this mountain of new debt is going to cause those danger premiums we talked about to rise even further. And the logic is pretty simple, actually. If the massive AI gamble pays off, the stock could totally soar. But if AI just turns into a giant black hole that just burns cash, well, it's the bondholders who are left holding the bag on a company with a really weakened balance sheet. It's a way to bet on the dream while still hedging against the final bill. So after all of this, what's the bottom line? What's the one thing you should really take away from all this? For me, it all comes down to a single number, 100 basis points. We just saw that the cost to insure Oracle's debt is already around 80. Well, 100. That's the real red line in the sand.
If you ever see that insurance cost cross 100 basis points, that's a powerful signal. It basically means the bond market is declaring that it has lost faith in the company's ability to grow its way out of this AI-fueled debt pile. It means that financial fever we talked about has become critical.
And that leaves us with one last big question. AI absolutely promises to reshape our world, creating unbelievable wealth and possibilities. But as we've just seen, building that future costs a truly mind-boggling amount of money. And it forces us to ask, when a revolution like this comes along, who ultimately gets stuck paying the bill?